in the number of mutually shared towers. So now we have started signing off on commercial arrangements as well. In 2009, we signed our first commercial site sharing agreement, and by the end of 2010, the number of shared towers which involved Uphone have crossed 2,000 now. What we have done as a second step is we have started signing up with infrastructure construction companies from Middle East who are coming into Pakistan, deploying towers for us with an intention of leasing it out to other operators who want to save on their capex investment. But what we feel is our achievement in this entire exercise is that within a space of 2.5 years, we have achieved a tenancy ratio of 1.3 per tower, as compared to an industry average of 1.07. That means that on for each of the tower that we have a sharing ratio of 0.3 on every tower. So we have clearly outperformed the industry in this respect. If you look at the learnings from this project, there were three essentials without which we could not have launched this initiative. First was the clarity of vision. There were no ifs and buts about it. We had to do it. And we had to get the buy-in of all the management and our board of directors. And we had to sell the business case externally as well as internally to all levels of management. Then there were three essentials which were required to take this to the next level. First was, of course, innovating and experimenting the deal structure. As I explained, we started with a barter arrangement. Now we are into a commercial arrangement with different operators and even signing up with external network infrastructure construction parties. Dedicating and aligning management KPIs to this vision. So we kept a specific target for it in the budget. We made our technical team responsible for that, and therefore we didn't have any other option but to go after it. And the willingness to share savings and strike a fair deal. Of course, when we do such deals, we have to strike a balance in a way that it makes commercial sense for both the parties. If we talk about the challenge very quickly, they came from the industry, especially the incumbents who were not ready to part with the strategic advantage of size. Then the landowners who saw this as an opportunity to make some money. But we had to be persistent and show leadership to overcome these challenges. In terms of savings, as I've mentioned, we have managed to achieve sharing on 2,000 towers nationwide. We are getting an annual OPEX savings from shared towers of approximately 950 million every year. And we have managed to save 5.5 billion rupees up till now in capex, and these numbers are growing every year. So this is what my presentation is about. Thank you.
Thank you very much, Nadeem Khan Sahab, and thank you. I'll just expect you guys to stay on stage for just 2 more minutes. We have a coffee and networking break right now, and you all can proceed to the halls from the exits on the left. We'll be back here in 30 minutes' time. But in the meantime, I'd like all the speakers and all the prize winners to stay back on stage and join us on stage for a group photo session, please. Thank you. Everyone else can please proceed, and we'll follow you guys there shortly. I'm sure you're all a bit refreshed and getting back to your seats by now. We now have a very high-powered panel discussion, and I would now like to call upon all of our panelists to join us on stage. Mr. M.A. Aleem, CEO and General Secretary, Overseas Investors Chamber of Commerce and Industry. Welcome aboard. And then Mr. Naseem Beg, CEO of RF Habib Investments. If you could kindly join me on stage. Mr. Zafar Iqbal Subani, CEO of Liberty Power Tech. And Mr. Asadi Shah, partner at M. Yusuf Adil Salim and Company, a member firm of Deloitte and former president of ICAP. To moderate this session, I am calling Mr. Fareed Ahmed Khan, CEO of ABL Asset Management. Fareed has over 16 years of experience in the capital markets and internationally and within Pakistan. Fareed Sahab, your words.
Okay, ladies and gentlemen, Assalamu alaikum. I welcome you to the panel discussion on conversation with industry leaders, expectations and perceptions for the 2011 outlook. First, my panel members will enrich us with their views on how they see this year panning out. And after the discussion, we will open the floor for the Q&A. Now, one thing which I can say at the start, which is that given the unpredictable and volatile nature of the environment and the country that we all operate in, some of the conclusions that we draw will be outdated by the time you leave this room. But let's be an optimist and give it a try nevertheless. Now, most of us are confronted with the challenge of forecasting the key variables for next year and then incorporating them in budgets, targets, key performance indicators, etc. 2011 arrived on the back of 3 consecutive years of anemic GDP growth. We grew by hardly 3% per annum, which is quite low even by our own modest standards. Against this backdrop, now we try to conjure up the outlook for the next 12 months. A lot of contradictory data rains down on us. To start with, rupee is stable. On the other hand, inflation rate remains one of the highest in the region. But external accounts are healthy and reserves are near record highs. Our national saving rate at 10.7% is the lowest that it has been in the past decade or so. And by the way, do you know that Pakistan's total domestic debt is now at rupees 5.3 trillion, which is more than the deposits of the entire banking system? Now, that has got to be bad for the liquidity and interest rates going forward. But even in this doom and gloom, we see foreign portfolio investment numbers which remain quite impressive, even in a regional backdrop. So, what do businesses and financial planners make out of this confusing picture? What variables to focus and which issues to look at as we make our budgets and board presentations? My fellow panelists will soon offer their views and conclusions. On my part, just to start the discussion, I'll just highlight some of the key areas which are on the back of our mind and hence should be a part of the variables that we look at when we consider the 2011 outlook. For example, I think inconsistent and at times unfriendly government policies. I mean, who would have thought that our corporate tax rate this year will be higher than 35% when we were making our budgets? A positive trend, which is redistribution of purchasing power from urban to rural areas. Well, yes, inflation and taxes have reduced the purchasing power in urban areas, but at the same time, the commodity price boom has seen a resurgence in demand in the rural areas. Businesses can only ignore this trend at their peril. Law and order, and I need not elaborate on this, but apart from the usual way that we look at it, just consider another way to look at it, which is that the opportunity cost lost of not exploring oil and gas in some of our restive areas in the country, and how it affects our energy situation, then how it affects our cost of production, and hence the GDP growth rate. Onerous and at times convoluted taxation regime, which is taxing already the heavily taxed, and heavy reliance on indirect taxes, which is negative for consumption, and energy shortages. How many industries suffer outages, how it increases our cost, and how much do we have to bear as a cost of this inefficiency as a nation. Now, with these words, I turn towards my fellow panelists for their opening comments. I asked Mr. Aleem to start the discussion and give his views.
Assalamu alaikum. Thank you very much, Fareed, for giving me the opportunity to talk first. Well, ladies and gentlemen, in my current role, I am the Secretary General and Chief Executive of the Overseas Investors Chamber of Commerce, which, as you may or may not be knowing, is a body of about 185 members, all foreign companies, and in total they contribute about